More big news in the world of Twitter. Elon Musk says he is terminating the $44 billion Twitter deal. If we look at the stock price right now, it has had an effect already, down 5% to $35.04 a share. What we're going to be doing today is talking about this deal, what has happened, what it means for the stock and also for Musk. Then we're going to be looking at my discounted free cash flow model and Buffett Graham intrinsic value model spreadsheets to see what the fair value is of Twitter, the stock price prediction based on the most recent financials. We'll be talking about the sheet more in a bit. Let's get into the news. So Elon Musk says he is terminating the $44 billion Twitter deal. The social media company Twitter vows to enforce agreement, setting the stage for a fierce legal battle. The official reason why Elon Musk is terminating the deal is because he's accusing them of disclosing false and misleading information about the number of fake and spam accounts. Real reason is we'll never know, but that is the official reason. The Twitter has been trading well below Musk's offer of $54.20 a share. If he was to buy it, he would have had to buy up the shares at that price. So if you had Twitter for $30, Musk buys at $54, you're pretty happy there. But you can see the share price has fluctuated, never quite reached that $54 and then dropped down again massively. So you can see when he was revealed as the shareholder, it shot up and dropped down when it was on hold and then has dropped down again. One of the other things is the agreement includes a $1 billion reverse termination fee that Musk would owe if he withdrew from the deal. Very, very interesting nonetheless. Can you please give a like on the video? Really helps me out. And let's go to my spreadsheet here. So this is my discounted free cash flow model and Buffett Graham intrinsic value model spreadsheet. It gets 99% of the data from APIs and populates it here. So if we type in Twitter, you can see it loads up the free cash flow statements. It gives us the free cash flow, the revenue, and then we can look at the models. But let's just have a quick look at Twitter's financials, the most recent ones, to see what's been happening with the stock. 2018, it went from 3 billion, 3.5, 3.7, 5 billion, and the trailing 12 months, 5.2. So revenue is increasing for Twitter, which is good to see. Profit here, net income, common stock, it was negative in 2020 and 2021, but you can see in the trailing 12 months, it is positive again. Not what it used to be, but definitely increasing. Are they buying back their shares or issuing more shares? They are actually issuing more shares. Why is this potentially a problem? Well, if you own 10 shares of a company if there's 10 shares of a company and you own one, you own 10%. If the company then issues 10 more shares to 20%, you now own 5% of the company, meaning you have lesser share of the profits. Now, can this be good? Yes. When they issue more shares, they can use that to gain capital or raise capital. And as you can see, the stock price has been going up in 2021 and 2020. So if they're issuing more shares at this point and the stock is now lower, that has worked out quite well for them. But overall, you would like it if they're buying back their shares. And finally, free cash flow. That is the final thing I look at. Let me just load the page here. Free cash flow of Twitter. It was positive and is now negative. 855,762,119 and minus 385 million. So I don't think discounted free cash flow is going to like this stock, but let's take a look anyway. So it's working based on averages here. Let's just see what the value is right now for Twitter. And you can see that it is that's a massive share price. Now you can see that the values here are a little high because it's taking averages. I don't think this is the average free cash flow rate. So let's bring this down and look at these. We'll manually override it, say about 50%. That is in line with the other ones. Revenue rate, I'm still pretty happy with, although it should probably be a little bit higher. This 2020 number decreased a bit. So let's say the average revenue is about 19%, and we'll keep the net income margins the same. If they can turn it around, it could be about a $48 stock. I'm a bit happier with those free cash flow numbers. So discounted free cash flow model says the stock is undervalued at the minute if it can continue growing in terms of free cash. Now these are a bit on the high side once again, so let's lower this and bring it down. Now, let's take the averages of this one and do it about 16%. And what would that give us? Well, still says the stock is about undervalued. And also, interestingly enough, below Elon Musk's buy price. The next is the Buffett-Graham intrinsic value model. It takes earnings per share expected growth rate and the current AAA bond yield. So let's just have a look at the current AAA bond yield. This has increased massively. You can see it's 4.24%. It's shot up very recently. It was almost 2% this time 6 months ago, but obviously with all the turmoil, it's increased. So I've already added that value in there of 4.24%. And if we look at the expected growth rate of the company, this is the next 5 years. Yahoo Finance says it's around about 101%. So let's add that into the sheet. And, oh, have I lost the sheet? Let's bring that sheet back. Luckily, I know lots of shortcuts, so we're all good. And then we'll look at the, we'll add that 101%, 101.4%. And what does that bring us in terms of the fair value? $54 a share and a Graham price of 41. And the Graham price is kind of a margin of safety of around about 25%. So that is a sort of buy and hold, and you buy and hold forever. So surprisingly, both of the models do say this stock is a buy. Free cash flow a bit more difficult because of the more negative free cash flow. If free cash flow is negative, then I don't think the free cash model would like it. But interestingly enough, with this big expected growth rate, the Buffett-Graham intrinsic value model says the stock is a buy. So both models looking pretty positive. Right, guys, thanks for watching. Please give a like if you've enjoyed the video. Check out the Patreon for this sheet. It's sort of the version 1 of this. I'm going to continually change it. But if I just, add in another stock, let's just do Coca-Cola. This will all change. And let me just put in the averages so we can see what it does. 1.02. Okay, so there you go. There's Coca-Cola. And then say we wanted to look at Apple, it would then load all the stock information for Apple, McDonald's, etc. So yeah, right, guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.